Every trader I have ever worked with has asked me the same question in one form or another. They ask it differently depending on how long they have been trading. The beginner asks, what is the best strategy? The intermediate trader asks, how do I adapt to different markets? The advanced trader asks, how do I stay profitable when everything changes? They are all asking the same question, and the answer is so simple that almost nobody believes it the first time they hear it. There is one rule, not a collection of rules, not a system with 14 conditions, one rule. And this one rule is the reason some traders survive bear markets, flash crashes, regime changes, sideways grinds, and every other environment the market has ever produced, while the majority of traders are chewed up and spit out the moment conditions shift away from what they are comfortable with. The rule is this: treat every single trade as one of the next 1,000. That is it. That sentence. If you truly understand what it means, not intellectually, not as a platitude you nod along to, but at the level where it changes how you feel when you are inside a live trade, it will transform your relationship with the market permanently. And if you do not understand it, you will continue to ride the emotional roller coaster that eventually throws every undisciplined trader off. Let me explain why this rule is so powerful. And I want to start by showing you exactly what happens inside the mind of a trader who does not follow it, because I guarantee you will recognize yourself in what I am about to describe. You take a trade, it loses. How do you feel? You feel bad. Maybe slightly bad, maybe devastatingly bad, depending on the size of the loss and how the day has been going. Now you take another trade, it loses. The bad feeling doubles. Not literally, it more than doubles, because losses compound emotionally in a way that is disproportionate to their financial impact. Now a third loss, and here is where the damage happens. After the third loss, you are no longer trading your system, you are trading your emotions. The fourth trade, if you take it at all, is either oversized because you are desperate to recover, or undersized because you are terrified of another loss, or skipped entirely because your psychological capacity to take risk has been exhausted. 3 losing trades. That is all it took to destroy your process. Not 300, not 30, 3. Now think about what that means mathematically. If your system wins 55% of the time, which is a genuine edge, a profitable system over a large sample, you will experience 3 consecutive losses regularly. Not occasionally, regularly. It is a statistical certainty. Run any 55% win rate system through 1,000 trades, and you will find streaks of 3, 4, 5, sometimes 6 or 7 consecutive losses scattered throughout the sample. They are not anomalies. They are the normal, expected, mathematically inevitable consequence of trading a probabilistic system. And yet, 3 losses in a row is enough to break most traders' discipline. 3 losses is enough to make them abandon a winning system. 3 losses is enough to send them searching for a new strategy, a new indicator, a new guru, anything to escape the feeling that their current approach is not working. But their approach was working. It was a 55% win rate system. It was making money over the sample. The 3 consecutive losses were not evidence that the system was broken. They were evidence that the system was functioning exactly as probability dictates. The trader's inability to see that the trader's insistence on evaluating their system trade by trade instead of over the full sample that is the actual problem. This is what the one rule solves. When you treat every trade as one of the next 1,000, you stop extracting emotional meaning from any individual outcome. You stop letting 3 losses define your state of mind. You stop letting a single big win make you overconfident. You stop the exhausting, destructive, account-killing cycle of emotional reaction to every trade. Because here is the truth, and it is a truth that most traders never fully absorb. You do not know what is going to happen on the next trade. I do not care how perfect the setup looks. I do not care how many confluences are lining up. I do not care if this is the best signal your system has ever generated. You do not know what is going to happen. You do not know what is going to happen on the next trade. I need you to read that sentence until it stops being an idea and starts being a felt reality. Because until it becomes real to you, until you genuinely accept it, not as a philosophical concept, but as the operating truth of your trading life, you will continue to attach expectations to individual trades. And expectations are the raw material from which emotional devastation is manufactured. When you expect a trade to win and it loses, you feel cheated. When you expect a trade to lose and it wins, you feel lucky rather than skilled. When you have no expectations about any individual trade, when you have fully internalized that this trade is simply one data point in 1,000 trade sample, you feel nothing about the outcome except mild professional curiosity. Did it win? Interesting. Did it lose? Interesting. Did I follow my rules? That is the only question that matters. Now let me show you how this rule changes your behavior in every market condition, because this is the part that answers the question every advanced trader eventually asks. How do I stay profitable when the market changes? In a trending market, your system probably performs well. Wins come easily. Confidence builds. And the natural temptation, the temptation that destroys more traders in bull markets than bear markets ever have, is to increase your risk, to lever up, to ride the wave, because it feels like the trend will never end. It always feels like that right up until it does. The one rule prevents this. If this trade is one of the next 1,000, then the current trend is a temporary condition within a much larger sample. You do not increase your risk because the recent trades have been winners. You do not change your position size because the market feels favorable. The market always feels like something. Feeling is not data. Your risk stays fixed. Your process stays fixed. Because the trend is not information about the next trade, it is information about the recent trades. And recent trades have no predictive value for the next trade. I know what you are thinking. You are thinking that is overly rigid, that surely you should be trading larger when conditions are favorable and smaller when they are not, that adaptability is a virtue. And in theory, it is. But here is what I have learned from decades of watching traders try to adapt in real time. The vast majority of them are not adapting to market conditions. They are adapting to their emotional state. They call it reading the market. It is not. It is reading their mood. And their mood is a terrible indicator. When the market shifts, when the trend ends and chop begins, the trader who has been trading the one rule is positioned identically to how they were positioned during the trend. Same risk per trade. Same process. Same execution. Their win rate may decline temporarily as their system adjusts to the new conditions, but the losses are contained because the risk was never inflated. The drawdown is manageable because position size was never escalated during the good times. And their emotional state is stable because they never allowed recent results to dictate their behavior. Contrast this with the trader who sized up during the trend. When the chop begins, they are now taking those inflated size losses in a low probability environment. The drawdown comes fast and hard. The emotional response is immediate and intense. The threat detection system activates. And within days, sometimes hours, they have abandoned their system, abandoned their rules, and are making decisions based entirely on fear and desperation. Same market, same shift in conditions, two completely different outcomes. The difference is not skill, it is not intelligence, it is not experience. The difference is one rule, followed consistently. Let me talk about the practical implementation, because I want you to leave this with something you can do tomorrow morning, not just something you understand. The first practice. Before your trading session begins, you write a single sentence in your journal. The same sentence every day. This trade is one of the next 1,000. I do not know what will happen on this trade, and that is acceptable. You write it by hand, not typed. Not recited from memory while you sip your coffee and check the chart. Written. The physical act of writing activates a different kind of processing in your brain than passive recitation. It forces engagement with the content. You write it, you read it, and you let it settle before you look at a single chart. I know what you are thinking. You are thinking this is silly. You are thinking that writing a sentence in a notebook cannot possibly affect your trading performance. And I have watched hundreds of traders have exactly that reaction. The ones who did it anyway, the ones who committed to the practice for 30 days despite thinking it was pointless, came back and told me it was the single most impactful change they had made. Not because the sentence contains magic, because the sentence, written daily, gradually rewrites the cognitive framework through which you experience every trade. It moves you slowly but reliably from an outcome-oriented mindset to a process-oriented one. And that shift changes everything. The second practice. You commit to a fixed risk per trade that does not change based on any condition, internal or external, not based on how confident you feel, not based on how many consecutive wins or losses you have had, not based on what the market is doing, not based on your profit and loss for the day, the week, or the month. Fixed. The same number. Every trade. The specific number matters less than the consistency of applying it. For most developing traders, 1% of account equity per trade is the standard. But the exact percentage is not the point. The point is that it never changes. The point is that trade number 472 carries the same risk as trade number 1 because they are both single trades within the same 1,000 trade sample. Neither one is more important than the other. Neither one deserves more risk or less risk. They are equivalent data points. When you violate this, when you increase your risk on a trade because it looks really good, or decrease it because you are on a losing streak, you have just told your brain that some trades are different from others, that some trades matter more. And the moment you believe that, you have re-entered the emotional framework where individual outcomes carry weight they should not carry, where a single loss can derail your day and a single win can inflate your ego. You are back on the roller coaster, and the roller coaster always ends the same way. The third practice is the hardest, and it is the one that separates the traders who eventually internalize this rule from the ones who understand it intellectually but never live it. After a losing trade, specifically after a losing trade, not after a winner, you rate the quality of your execution on a scale of 1 to 10. And then you ask yourself one question. Would I take this exact same trade again knowing it was going to lose? If the answer is yes, if your entry was valid, your stop was correct, your management followed your rules, and the loss was simply the cost of a trade that did not work out, then you write, good trade, good loss, one of the next 1,000, and you move on. If the answer is no, if you deviated from your rules, if you entered early or late, if you managed the trade emotionally rather than systematically, then you have genuine information to work with. Not emotional information, behavioral information. You can identify the specific deviation and address it, but here is the critical distinction. In both cases, the good loss and the bad loss, your risk on the next trade does not change. Your process does not change. Your emotional state may differ, but your behavior must not. The loss happened. It is in the past. It is one trade, one of 1,000, and the next trade is a completely independent event that has no relationship whatsoever to the one that just ended. This is what probability thinking actually looks like in practice. Not as a graph on a whiteboard, not as a formula in a textbook, as a moment-by-moment discipline where you refuse to let the past trade contaminate the next one, where you treat every trade as a fresh flip of a weighted coin, knowing that the weight is in your favor over the sample, and knowing that any individual flip is meaningless on its own. Let me tell you what happens after 3 months of following these 3 practices, because I have watched it happen enough times to describe it with precision. In the first 2 weeks, you will find it difficult. The daily sentence will feel mechanical. The fixed risk will feel constraining. The post-loss evaluation will feel tedious. Your brain will resist because your brain has been conditioned over months or years of trading to treat every trade as a separate emotional event. Reconditioning takes time. By the end of the first month, something begins to shift. Losses still sting, but the sting fades faster. You start to notice that your behavior after a loss is more consistent. You still feel the pull to modify your risk, but you do not act on it. You still feel the emotional spike, but it dissipates before it reaches your hands. The gap between feeling and acting begins to widen. That gap is discipline. By the end of the 3rd month, if you have been genuinely consistent, not mostly consistent, but genuinely consistent, you will experience something that you may not have words for the first time it happens. You will take a loss, and you will feel almost nothing. Not numbness, not suppression, genuine neutrality. You will look at the losing trade and think, that was one of the next 1,000. My rules were followed. The outcome is irrelevant. And then you will turn to the next setup, evaluate it against your criteria, and take the trade with the same calm focus you brought to the last one. That moment, the moment where a loss produces no behavioral deviation whatsoever, is the moment you become a professional, not in title, in psychology, in neurological structure, Your brain has been rewired through 3 months of deliberate practice to treat individual outcomes as what they actually are. Single data points in an ongoing probability experiment, not verdicts on your competence, not evidence of your future. Data points, nothing more. And when you reach that state, the state where every trade is genuinely, experientially one of the next 1,000 market conditions stop mattering in the way they used to, a bear market is not a crisis. It is 1,000 trades with a different distribution of winners and losers. A choppy market is not a nightmare. It is 1,000 trades with wider variance. A trending market is not a paradise. It is 1,000 trades with a temporary tailwind that will eventually reverse. Your response to all of them is identical. Same risk, same rules, same process, same calm. This is what sustainable profitability looks like. Not the right strategy for the right market, the right psychology for any market. And the right psychology is built on one rule, applied consistently across every trade, every session, every condition the market will ever produce. Every trade is one of the next 1,000. You do not know what will happen on this one. That is not a problem to solve. It is a truth to accept. And the moment you accept it, truly accept it, in your body as well as your mind, the market loses its power to control you. That is freedom. Not freedom from loss. Freedom from the emotional destruction that loss creates when you treat a single trade as anything more than what it is. One of the next 1,000. That is all it ever was.